Hello. So good afternoon, everyone. I hope everyone's having a wonderful day today. My name is Luigi Alcañeses. I'm going to be the presenter for today's lecture. The topic for today's lecture is actually just very simple. It's going to be an age of behavior in economics. This is for the NDC 2022 Diliman lecture series. I just wanted to greet everyone and wish everyone luck in the tournament if you're competing in NDC. NDC is a wonderful place where people learn and become better people, become humbler people in the community in the Philippines, where we try and make debating better for ourselves and for everyone else. And I think that's a very, very important thing to remember when we're in this setting of learning and in reflecting on what we want to do in this community. All right. Having said that, what I'm gonna do in today's lecture is I'm gonna first give a few caveats on what this lecture is going to be about. Because the theme is on finance, development, and economics. Obviously, we're not covering everything about that, but I want to be very specific with what we are going to tackle in today's lecture. So this lecture is not going to be about, like an economics lecture on, what economics is like, or what everything in theory and economics, like, where I'm going to teach you what an interest rate is. You should know what the interest rate is. I'm not going to teach you what quantitative easing is. Like, everyone does that all the time whenever they do this lecture. So what I'm going to do instead is, because I think that's a comprehension issue. Like, comprehension issues are very, very easy to resolve whenever you're learning these types of things. What I want to focus on is what you can work on and develop as a skill in economics debates. So another way to entitle this lecture is just, even if it's not in the context of economics debates, it is in terms of understanding how to characterize incentive structures in debate, which I think is very, very important, not only in economics debates, but in all debates, right? Let me give a clear example right now before we move on to the rest of the lecture proper. We're in the election right now, election season in the Philippines. There's one political science case that you might be aware of, which is the wasted vote problem, wherein to justify and prove the voter apathy that may exist among the population and why individuals do not show up to vote, you can think of this as a game theoretic problem, right? You can think of it as a situation if you were in the majority and you believe that your vote is not as significant as other individuals that would participate in this election, because you obviously believe that it is very, very unlikely that one vote is going to change the outcome of an election, then you would likely not participate in that election because of the cost that you might incur if you participate and go out on your day. You run out into the streets, you go in a very, very long line, you write down on a ballot paper, and then you go back home, which basically means you spent an entire day, which you otherwise could have spent doing other things that you would have wanted to do in your life. And that's just a simple political science concept that just explains why, if you have this way of thinking, then it is also likely that other individuals would also have this way of thinking, which also erodes the ability for you to have more individuals participate in the election, consequently also meaning that individuals will also not trust in the results of that election and make it harder and harder for the stability of the democratic system to maintain itself over time. And what I just did here is nothing magic on economics. I just explained why there are reasons for individuals to deviate from an expected norm, which is they would not show up to vote because it is within their incentive to stay at home. Very, very simple. So when we're thinking of economics debates, my recommendation for everyone is, you don't have to be too intimidated. You don't have to be scared with all the jargon and all the terms. This can all be simplified or argued, debated in terms of things you are familiar with, such as explaining the likelihood of scenarios and how people are likely to interpret those scenarios vis-a-vis their decision-making process, and how this interacts with their value system and how it interacts with the likelihood for them to make certain decisions over other certain types of decisions. And that's pretty much it. that is what we mean by agent behavior in economics debates. What I'm going to do is the following in today's lecture. So the outline will be as follows. Number one, I'm going to talk a lot on characterizing the agent, and what constitutes the agent, and just a brief overview of what we are expected to debate about when we are talking about stakeholders in debates. Number two, I'm going to talk about the concept, which is the bulk of this lecture, of the utility function, which is just one way of explaining how individuals value certain things in their own life and how they make decisions on the basis of this utility function. And I'm going to talk about certain components that may influence the way in which this utility function manifests in their life. I'm going to specifically talk about available information, expected utility, the behavior of other agents, and time preference. And then lastly, I'm going to explain certain concepts on final notes on stability and uncertainty, because I think this is usually prominent in most of the debates right now, like, in the post-COVID context, where a lot of what will happen in the future or what will happen in the next few years is unknown. And this understanding of uncertainty is also clear when you think about all types of debates, right? There's always some degree of uncertainty that you are dealing with, that every agent is dealing with. How do you debate that instead of just arguing in generalizations and in absolutes? Because again, none of us should argue in absolutes, because debates are won in the vast majority of cases and proven in the likelihood of cases in which this vast majority will come about. All right. I think that is what we are talking about in today's lecture. If there are any questions, or if people have any things they want to say or comment, then I would invite you to do it at the end of the lecture or on the Slido that was also put on chat. For those that are watching the recording, then I hope that you enjoy. All right, game. Let's go. So the first thing I want to go over is characterizing the agent. An agent can be defined in this sense, at least for the purposes of this lecture and for the purposes of understanding it in an economics debate, is that it is any individual entity that serves as a significant decision maker in a certain economy. So this definition can be broken down part by part, right? When we are talking about an individual entity, we are talking about any entity. We're not just talking about people, not humans alone, but we are also talking about entities that are able to make decisions for themselves. So a corporation is an entity. A state or a government institution is also an entity. And we can also talk of collective entities as also singular individual entities as well. Like you can talk about a social movement as its own individual entity composed of different individual entities of people that have their own certain preferences that are also aligned within a certain organization. So it always gets complex whenever you think of it in that way. And that is what is beautiful about this, right? You're able to look at the complexities of how individuals make decisions, how internal inequalities are created within these entities, and how you're able to make decisions on that basis. So when collectives align on their mutual incentives to make progress on a certain issue, then because it is in their incentive to pursue a certain course of action, you would argue that this is more likely for them to do XYZ over ABCDY or whatever, right? That's what we mean by an individual entity. Any individual entity that has singular decision-making power for themselves. And yeah, obviously, it can be clearly defined, it can be clearly delineated, it can be clearly separated and separable from other entities, because there is a clear, distinct difference between an entity A and an entity B, because entity A might have their own characteristics that are different from entity B, and entity B might have their own values that are also different from entity A. First part. Second part, they serve as a significant decision maker in a certain economy. When we are talking about being a significant decision maker, we are not talking about people that are decision takers. Yeah, I hope the jargon makes sense here. We're not talking about people that are merely affected by decisions. We are talking about people that are making active decisions in a certain context. So we are talking about a labor and a company dispute, then we are talking about how an individual entity like a laborer or a labor union is able to significantly alter the incentives of another institution, such as a corporation, by being able to have certain leverage in that situation. What is important here is to describe how much leverage they have with respect to a corporation, and how a corporation has leverage over a certain employee and certain set of employees. And we are also talking about how they make this decision and how the decision-making process will come about. If it is a labor union, then they may have this decision-making process through an internal election, for example, or an internal discussion. If it is a corporation, this internal discussion process may exist in a board of directors or through the investors and the way in which they would pressure those board of directors and how they would make decisions on that basis, right? I think it's also important here to note that decision makers are not always the all-powerful ones. Even, you can be significant even if you are individual entities. So when we're talking about a loaning crisis or a financial crisis, when we're characterizing the panic in which individuals would approach a financial recession, you could still argue that the panic that would ensue in individuals pulling out their funds from different banking institutions would be a significant decision that may affect a certain area of the economy. Again, it's important to be specific. How much influence do they have and leverage do they have in this situation? How is this decision-making process made? And what happens? And the last thing to mention in this definition is it happens in a certain economy. So for the purposes of debate simplicity, it's always important to remember, and this happens all the time, right? People make decisions in a certain transactional setting, or in other words, in a market, in an economy. They make it in a certain environment. They make it within a certain expectation of the degree of influence their decision would have on other participants in that same economy. So when you are making a decision on whether or not you should take a loan to subsidize or pay for the education of your child, if you are coming from a poor family, you are making this decision within your specific economic community with the understanding that you are taking a loan from a specific banking institution that is under the regulation of your specific government, which you also voted in. And you are also taking into account that your money that you are taking is money that comes from the specific economy that you are a part of, that you also work a job for, that you earn money from, so that you can pay the loan later on, and so that you can later on pay for this loan after their child is done with their education, and then later on improve your economic circumstance. Again, all within a certain vacuum economy that we are talking about here, because obviously that decision is not made with respect to the decision of, I don't know, some rich privileged household on the other side of the state. It is made within a specific economy with specific circumstances, with a specific incentive structure that each and every participant has in it. So again, from that line of analysis alone, we already have a lot of arguments to talk about. I mentioned the state, I mentioned school institutions, I also mentioned banking institutions. All of these play a part in that single transaction, and how it affects the economic circumstances of this individual person in the future. All right, that's the first bullet point down. In other words, one way to explain this is, what is the role of this decision maker? How much influence do they have? And you may have multiple roles. People may have more important roles and people may have less important roles in an economy. And the arguments you would make determine the level of impact that comes from the influence and roles that these agents have in an economy. So again, when we're talking about the central bank, for example, their impact is very large, but obviously analyzing their behavior and how they would specifically behave is a very important hurdle to overcome. It may be easy for you to argue the likelihood of how certain individuals, like single individuals, may behave. Like you may talk about like a specific subset of conservative, rural workers from the Rust Belt in America that were displaced by globalization, and how they would try and discriminate against immigrants if the state were to pursue a more free market policy. But again, you may argue that specifically, but the impact may not be as large as the impact of a central bank. Obviously, this is for obvious reasons, because you know that the central bank's influence is much larger than the influence of a community of rural, conservative, Rust Belt workers that were displaced by globalization in this specific place. Again, both are valid arguments. They're perfectly fine, good things to talk about. But it is important to acknowledge what influence they have in the debate and what impact they're able to create, and the likelihood of truth that comes from this. The last point I want to emphasize in this slide is this. There is this conception in economics debates, or in economics in general, that which is a valid conception, it's valid, but I want you to interrogate this belief more when you are in a debate setting. Agents are self-interested. What does that mean? What does it mean when we say an agent is self-interested? When they act on their self-interest, what does that mean? And I would want to argue, and I hope you would understand, that this does not just mean that they are a greedy, non-altruistic robot that will do anything, whatever it takes, like in Avengers fashion, to be able to bring harm onto others and only bring benefit to themselves, like as if they were Jabba the Hutt doing whatever they wanted, right? And ensuing crime into the rest of the world. Self-interest in the perspective of an agent is done within a certain context and a value system in which this self-interest manifests. This is very, very important, because when we think about the decision of a migrant to migrate from a rural area to a metropolitan area, that decision is made out of self-interest. And that self-interest can be broken down into several different components that constitute what that self-interest means. It could mean that your pursuit of a better education is your means to improve the conditions of your family back home. It could also mean that your pursuit of going to another place is your freedom from being able to go away from your family and the conservative ties that you might have come from in a rural place with less liberal values, for example, or less liberal economic freedom that you might otherwise not have had, right? Self-interest here is not just in only one conventional sense. And neither is it also just only in terms of financial gain. When we think about self-interest and the pursuit of a better life or happiness for a person, money is important, but it is not only important in and of itself. Because, obviously you can argue that money is a proxy of other goods that individuals may otherwise have. You can also argue that money is the representation of things they would otherwise want. And you can argue in the same breath that the harms to self-interest, the costs, the opportunity costs that individuals face are measured in monetary terms, but are also evaluated and they manifest in non-financial terms. Right? Let me give a simple example. If you are abandoning your child in the school and you were going to go gambling instead, right? That opportunity cost, which is measured as the amount of money you would spend in that casino, is essentially how much you are valuing, how much you are willing to give up to not see your child in the school. I mean, that's basically it. Financial gain is a good way for individuals to measure benefits or harms to themselves. But in debate, it is very, very important to recognize that this is not only in terms of the money alone, it is in terms of goods that are pursued or are failed to pursue by certain agents in this process. Let me just concretize this as an example. So the example here is this house believes that states should invest in big casinos to rejuvenate economically disadvantaged areas. I think there are many agents you can point out here, right? They're very, very simple. You can talk about how big casinos are more likely going to have an incentive to enter into an economically disadvantaged area if the state invests in big casinos. This is a very simple incentive structure. A big casino knows that it is very, very risky now to invest in an economically disadvantaged area for many different reasons, ABCDY, ABCDY, ABCDY. How do you alleviate each and every one of these reasons, and how do you make it easier for them? The investment that they would otherwise get from the state makes it easier for them to shoulder these costs, and therefore it is within their self-interest for them to be able to accrue this bidding and the subsidy they would get from the government. And it is within their interest to attract more and more consumers from this area to participate in their casino, even if they are from poorer sectors, so that they can earn more money in that process. Again, part of self-interest, part of their ability to compete against other companies, part of their ability to improve their stake within an economically disadvantaged area. On the other hand, if we were talking about a certain individual that is from a poorer community, that their incentive structure is that this state is investing in big casinos. You know that there is this prospect that more investment is going to come. You know that other casinos are going to enter into this area as well. This might create many opportunities for you. So it does not necessarily mean that you are going to only pursue gambling as the only clear alternative, but it also might mean that the opportunities for you to uplift yourself economically may be higher if you can get employed under many of these institutions to work in the service industry, for example, because you may also argue that the expectation of other businesses to enter makes it easier for these specific individuals to buy into government welfare systems and cooperate with the government, so that they're able to commit to a conditional welfare transfer program, or many of these programs that help alleviate them from poverty, which is not obviously limited to just gambling alone. I knew you guys were expecting me to make an argument that poor people end up gambling, but that's not what we're talking about here. We're talking about how self-interest is more complicated, and how an incentive structure is not just limited to one person blindly doing this for no other reason, but it is done within a condition. It is done within a certain environment, and it is done by certain significant decision makers within their own economy and within their own vacuum settings to be able to improve their own lives. Again, improve their own self-interest. All right, this is the core. This is the core understanding of the framing for this lecture. Again, I titled this slide to be characterizing the agent, because what we are essentially doing is we are framing the agent. Remember, framing is the process of proving that certain arguments are important, or that certain impacts are important, and the implications of those arguments are important in a debate. So when we are characterizing the agent, that is a debate in and of itself. That is a debate that deserves its own significant numbers of minutes to discuss in the debate, even before you are arguing anything else that would happen in that debate. And then later on, that's when you would do the other things that you would want to talk about. All right. So this is the main important learning point from this part, the characterizing the agent. So allow me first to just take a moment to drink water, and I will allow you to just think and then brainstorm, and then I'll just be back in 30 seconds. All right, game. Let's go. The next slide is on the utility function. So I titled this the utility function, and the next few slides will be the components of the utility function that would influence and alter the way in which this utility function manifests among different agents. But what I want to highlight in this particular slide is just a very, 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 very simple concept. It is that there are many components to an individual's utility function. A utility function just means the happiness function of a person. What makes this person happy? What makes this person fulfilled? What makes this person more and more likely to be satisfied with the current life that they have? Again, the utility function is a changing function. It's a changing function because it is the person that will always change. People's values change, people's priorities change, and there are many things that will make someone value certain things over other things in the short term, in the long term, blah, 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 blah. But you can also argue that there are many things that are very long lasting in a utility function, which are very stable components of that utility function, such as, I don't know, some people may argue it might be family, some people may argue it might be financial gain for certain types of things, or it might be a certain long-term goal that they've been pursuing for a long time in their life, etc., etc. For simplicity purposes, this can be imagined as a linear equation with different weights assigned to the various goods a person seeks. So you may just imagine this as like, let's say you're going to a convenience store, and you have a 50% weighting towards Snickers, and you have a 20% weighting towards a toothbrush, and you have a 10% weighting towards Mentos, and 5% to everything else. You know that is the utility function a person would have. There are many goods that this person would pursue. These are things they would value. This is also the way in which you would evaluate the priorities and preferences that they have, and that you would be able to explain that based on their utility function, it is most likely that this person is going to buy a Snickers when they enter the convenience store. Right? You may argue that they have a 50% chance to not buy a Snickers, but it is significantly likely in the vast majority of cases, specifically 50% of cases, wherein this person would buy a Snickers. And that's debate, basically. That's debate. You're just proving why this likelihood structure is structured in this particular way, and why, because this likelihood structure is structured in this particular way, this is how this person is going to behave on that basis. And that's how you prove likelihood and how a person is going to do certain things over other things. Obviously, people are not as simple as just 50% Snickers all of the time. I'm sure everyone's aware of that, which is why I want to make this caveat very, very, very clear, which is the next bullet point. When we talk about assumptions on rationality, that is different from what is argued to be a rational choice. I think in debate, people often mistake and are very, very unclear with what they mean when they say a person acts irrationally. It's as if people are saying people are dumb. When they're not, no one is dumb. No one is acting irrationally. They are acting in their best self-interest according to how they perceive what that self-interest is in that moment. Which is not a bad thing. That doesn't mean it's illegitimate. That just means that they behave the way they behave And that is how we are able to understand why they behave in certain ways. So when we speak on an assumption of rationality, we are talking about the economic traditional sense of, people make a decision to maximize their utility. They want to maximize their happiness. We assume that things are done in a rational way, which means in the sense that people have a lot of information on the pros and cons that are provided to them. People are operating in an economy that is stable at the moment and does not have any market imperfections, which means that there is no monopoly, there's no duopoly, there's no market imperfection like a financial recession that would cause people to decide in a different way. And we're saying that people have a clearly defined utility function, which are all, these are all valid assumptions, huh? These are all valid assumptions that you can make in the vast majority of cases, right? No one's operating in a failing state. No one is operating in a financial crisis all of the time. And no one is operating with completely blind information all of the time, right? So people in debate settings, people usually argue along the lines of the assumptions of rationality already. But when we are talking about arguing if something is a rational choice, that's different altogether, right? It's different altogether because remember, our argument is that people are already making choices that are rational in accordance to their own utility functions in the way they are already formulating it right now. But what people are actually arguing in debates is saying that what is probably optimal for them is not the choice they are making right now. And then that is what you are saying is irrational. Honestly, I would just prefer if you guys do not use that terminology. Just say that they are not making optimal choices for themselves, or that they're not making utility optimal choices for themselves that would improve their own life in an objective particular way. But that is a very, very different thing from how they believe their life would improve in the pursuit of a certain course of action. That is very, very important. So again, the example is this house would impose significant restrictions on rural to urban migration. When someone makes the argument that poor people are stupid for traveling from a rural area to an urban area, that's a completely terrible argument, because there are many reasons in which you can believe that their prospect, the prospect of higher wages and a better quality of life, is significantly higher than the willingness for them to endure the costs of staying in a rural area, which for them would be significantly negative on their well-being and happiness. You may argue that it would be a socially optimal choice for them to stay together in a rural area, and the state would impose those significant restrictions, thereby creating economies of agglomeration wherein those individual and societies are able to create businesses together because they have a critical mass of individuals who might demand to be part of a corporation, and corporations are incentivized to enter into these areas because there's a stable pool of individuals that will stay in these areas. You may argue that is possible, but again, that is the perspective of a state imposing their beliefs in what is good and socially optimal for individuals. And by all means, people may eventually come to reason that this might be good for themselves if the state imposes this. But in the initial choice for them to go from a rural area to an urban area, it was still initially within their incentive structure to migrate because of the various costs and the various prospective benefits they would otherwise get in being able to pursue this type of course of action. Which is why subjective biases may or may not alter one's utility function, but those biases, such as a bias for, the predisposition that universities in metropolitan areas are generally better than the universities in rural areas, which is it's a predisposition, right? That bias does not automatically mean that the choice is automatically illegitimate. It might be revelatory of a lack of information or imperfect information, which again, it violates the assumptions on rationality, which again, which makes it easier for you to make that argument, but it does not mean that the choice in itself is illegitimate. That choice was still made within a particular incentive structure. That is important. All right. Next, the next point I want to emphasize. So now we're done with the main component of what do you call this? Utility function. We're now moving on to different components of the utility function that may significantly alter how this utility function manifests among people. And the first thing I want to focus on here is on available information. We were just talking about that right now already, right? So I think it's a good time to already discuss this now. When agents make economic decisions, this is largely based on the available information and the prospects that they have on anything. And I literally mean anything. I literally mean anything in this sense. Because all events, everything that you interact with, all media you interact with, all things that you do, they provide some information that you would use to create your utility function and compose who you are. Because in some way, your utility function is your identity. It is who you are. It is what you value. It is everything that makes you drive to do certain things and not do certain things. And in that sense, you would make your decisions based on the information that creates your utility function and the prospects in which that utility function value certain things that are more likely than less likely, right? Another way to state this is just very simple. People are socially conditioned by their environment, context, and community, and larger institutions take advantage of these gaps in information to exploit certain vulnerabilities. What's a clear example of this before I move on to the other example here? An example of this would just be that you might make the decision to pursue education in science, technology, engineering, and mathematics because of how you have been socially conditioned by your family, by your environment, by your context, by your community to be able to make this decision. You also make this decision to pursue this course of action because you know that the media talks a lot about how AI is becoming more and more prominent, how other types of jobs are becoming less and less relevant and automated, and that is why you might not want to pursue other things. You also know that you will get a high salary if you pursue a career in this type of job, which is why your prospect in knowing that if I pursue this job, my prospect in getting this job and my prospect in getting this job through entering into this education institution makes it more likely for me to get a higher salary, which will make it more likely for me to pay off my student debt, which makes it more likely for me to save money for my family in the future and thereby do all the other things I want to do in my utility function. That information, the information that you have a high salary, there are a lot of jobs, and it's good competition, everything else is failing, all of the rest of the economy is going to collapse, blah, 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 is information that you make that is available to you. And when we talk about larger institutions that take advantage of the gaps in information, I just want to point out one certain thing, right? One thing you might note from this example on the STEM and the automation example that I just gave is that your understanding of the high salary, the improvements in your life, all etc., does not account for whether or not educational institutions are capable of actually reaching the threshold of giving you the skill set that is required to get the jobs that you want. Which is why this gap in information that you are unclear of the specific skill sets and the specific expectations you should have on educational institutions means that your valuation of how much you are willing to pay for a STEM education is skewed by the lack of information of how much and how likely, how much it is required for you to get this skill set. Because all you want is to get that high career towards the end, thereby making you vulnerable to many, for example, many for-profit educational institutions that would scam you into entering into an educational program that would market to you that they would get into STEM degrees, etc., etc., but it would not be on par or be competitive against other educational institutions that might be offering the same types of degrees. You may also be vulnerable, for example, to taking an immediate student loan by certain loan agencies that would say that you need a college degree for you to pursue these types of jobs. You have to do it through our institution, and they are able to exploit the fact that you do not know how much this education should be worth for yourself, so that they will charge you very, very high interest rates against you, so that you would be indebted to them at the end of your educational career, thereby making it harder for you to pursue another career in the future, thereby also making it likely that you might be forced to pay some other form of damages or compensation to this financial institution, also making it harder for you in the future as well. Again, these are how a gap of information, again, it's not specific information, but it's a gap on the costs, the realized costs that you would face, and how the gap in realized costs that you may likely face is going to be exploited against you in this process. Right? So hopefully that's clear. That is essentially what we're talking about when we're talking about how available information can be exploited. On the other hand, an overwhelming amount of information can also be used to exploit individuals. Again, what's a good example of this? Again, the financial crisis of 2008. If everyone is aware of the information that a lot of people want to buy houses, a lot of people like buying houses and taking loans on these houses, and everyone pays mortgages, and everyone knows that the banks are very strong and they have a lot of money, and they have more and more information on the fact that more and more people want to buy more and more of these houses. That is a bias of information itself. It is the overwhelming information that the financial market is doing well, without any pessimistic information that the financial market may do bad, thereby changing your utility function, thereby changing your risk profile based on the information you have available to you. Which is why it was very, very easy for people to, be told they can get a mortgage, right? You get a mortgage from a financial company. They're like, oh, go ahead, you take our mortgage. You just pay it in 3 years or 5 years and you're good because you have a house anyways. Everyone else does this, and you can buy 5 houses if you want along with this mortgage and this loan. And so people do that. And that's how banks are able to take advantage of people, because of this hype or because of this hot hand fallacy that the financial market would continue to do well. What's another example? This house with nationalized credit rating agencies. I'm sure you're aware of the concepts of moral hazard and loss aversion. I'm not going to elaborate on that now, but again, just to be simple, currently banks take into account your economic circumstance when they accept a loan that you might apply for. Which is why, for example, right, they look at your credit rating. They see if you paid your taxes, have you paid your energy bills, have you paid your utilities, blah blah blah, and they're gonna be like, yeah, you've done it before, so you have a good credit rating. So now you're asking for a loan. Of course, I'm gonna give you this loan because you've paid your bills before. That transaction already has a moral hazard. What's the moral hazard? The moral hazard is that the banking institution cannot watch everything that you're doing 24/7, and that you as a person, you might be a very risky person, right? You might be a gambler, but the banking agency does not know that you gamble all of the time. You may be a smoker, and they don't know that you might end up paying for significant damages on health insurance because you had a emergency to go to the hospital, which makes it harder for you to pay your loan on the mortgage I mentioned a while ago. Which is why this moral hazard or lack of information makes it unlikely for them to be able to give this credit rating or this what do you call this loan to you. So in a debate on nationalizing credit rating agencies, part of what you would evaluate here is, are state institutions capable of gathering this information? Is there competition or collusion in the process of rating individuals and the credit ratings they may otherwise have in certain economic communities that are lesser in economic circumstance? Or would you also argue that because individuals have a lot of information how states operate, and they have information on which politicians they elected and which individuals would be put into the cabinet because they entrusted particular individuals to appoint these members into that cabinet, does that mean that this information asymmetry is also resolved because now individuals have more of a significant say in the appointment process or the electoral process because they are tied to this through nationalization? Or is it more important that the state has more information on financial institutions because they are now more actively involved in this credit rating process because they have to cooperate with different banking institutions in which types of loans they would rate as AAA or BBB, etc., etc. So again, I'm just raising questions. But what's important is that this debate on nationalizing credit rating agencies is not just on like, oh, risk person takes a loan, blah, 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 and then it's going to be bad for them. But it's about how does this change in how information is disseminated and how information is told to the public. How will this affect how people would make decisions into the future? Okay, so that they make it based on available information and they do it on that basis. Let me just charge my speaker. Just give me a moment, guys. Just gonna mute. Okay, all right. I think I can continue now. The next slide I'm gonna go over now is expected utility. So what we're doing now is, so again, right now we already established available information as one of the components of utility functions that would alter the utility function and how it would manifest. Now we're going on to expected utility. Agents make decisions not really based on absolute utility. So again, it's not just based on the raw perspective, right? But it's also based on expected utility, which is based on the probability weights assigned to different events. Let me give you a clear example. What would make it very, very hard for you to buy a lotto ticket? Just think about it. Just think about it. What would make it? What would be the cost of a lotto ticket that would be enough or sufficient for you to not buy the lotto ticket? Right? And guys, this is just as simple as calculating the expected utility, right? For most people, right? For most people, one of the ways you could probably understand how people would assign this expected utility is just on the probability, right? If you have a 0.0001% chance to win the lotto, but the lotto is valued at $100 million or whatever, and the cost of a lotto ticket is just, let's say it was 5,000 pesos, would you take that risk? And obviously the answer is likely yes, right? Like you definitely take that risk because you would value it as you have a 0. Blah, blah, blah chance of winning the lotto. You multiply that 0 point chance to the absolute number of how much you would value the lotto, the 100 million, and then you would compare that against the negative 5,000 of you spending on this lotto ticket and not winning anything, which might be a very significant percentage. Like you might have a 0.99% chance of like losing the lotto, and you'd multiply how much that cost might look to you. And thus you would make that decision on that basis. You would have different probability weights assigned to different events, and your expected utility, again, if you would play this game, the lotto, millions and millions of times, how much money are you expected to earn, right? How much money are you expected to earn on net? And would this be worth it for you to continue to spend more and more on this money? And this kind of scenario applies to everything. It applies to everything that you're doing. If you are arguing that someone is likely going to engage in a conflict with another state, what is the likelihood that this person would retaliate against you? If you're going to engage in economic sanctions against a weaker economy, and there's very, very weak chance that this person is going to retaliate against you, then it might be in your interest, in your expected utility, for you to spend on this type of aggressive behavior so that they might be forced to compromise or forced to accede to your demands, which is very, very likely if you spend more and more money on it. You may also argue that this expected utility understanding can also be argued in terms of the long term and nuclear disarmament, right? Like you think that you might spend a lot of money on developing nuclear technology, but you might say that the long term benefit of continued safety for your people, which is a very, very high likelihood if you have nuclear technology, because of mutual assured destruction, that probability is multiplied by a very, very high benefit of people being safe in your economy. And thus you're very, very, very happy and very, very willing to opt into a nuclear development program that allows more and more multiple states to participate in this nuclear arms race with each other. But again, let me be clear here. Let me be clear. Describing actual probability is different from describing expected probability. So there are many times this can coincide with one another, and oftentimes people are able to evaluate this for themselves. But there are many instances, again, in which a bias or a certain uncertainty or a certain lack of clarity on a certain event and the prospect of that event coming up to happen also affects the expected probability for something to happen. Let me give an example. This also gets the startup industry's focus on achieving a successful initial public offering as fast as possible. I'm sure you're aware of this, right? Initial public offering is when they go public from a private company. A startup allows their shares to be sold into the stock market, and then more and more people can buy shares in that company because now it's publicly available and publicly sellable, and thus the valuation of this company goes very, very high when the hype on this company is very, very high. And so they participate in this economy and this market. More and more bidders participate because more and more people are buying from this company because they want and they expect the valuation of this company to go higher into the future, and thus they will encourage more and more startup companies to do this process as well. Because of how this ecosystem operates and how the startup industry fantasizes about people having a very, very successful IPO at a very, very rapid rate through unicorns and more people getting billion-dollar valuations when they open up into the market, this skews the probability weighting of individuals when they, for example, when they invest into the company or any startup, or when they choose to start their own startup as well in that process. Because there might be a very significant low chance of them succeeding in a startup, but the prospect or the expected prospect of them succeeding in the stock market may be skewed because of how individuals are forced to change their preferences when more and more people are doing it around them as well. Again, I use the term that they're kind of forced to do so because it's very, very hard to opt out of this ecosystem of people constantly believing that this is the thing that is going to be the next big thing. And when it's endorsed by the state, it's endorsed by other people, it's hard to be the rotten egg that tries to say that there's something wrong with this entire system. That's one way of explaining expected probability. Again, it is always based on how people value and weight probability themselves. And it also depends on how their risk preference is weighted with respect to certain probabilities. Because obviously, if you are going to do something that's very, very low risk but high reward, then that means you're a more risky person. If you do something that's high benefit but low risk, then obviously you're a very, very risk averse person. Most people would take that option anyways. All right. Are there any questions on this portion of the lecture? So I'm just going to take a moment to drink some water again, and then I'll be back with you. All right. I hope everyone's having a great day. We are halfway done with this lecture. We're now moving on to the other parts of this lecture. So far we've already tackled characterizing the agent. So far we've already talked about characterizing the agent. We've talked about the utility function. We've talked about some available information and expected utility. Now we're going to move on to the last two parts of the utility function. And then I'm going to move on to the concluding part of this lecture, where I talk about some final notes on stability and uncertainty. And I'm going to probably end with some exercise for you that we can also discuss together. And then hopefully by around 4:30, I hope to end early so that we can have lots of time for questions. And then we're going to end it definitely by 5 p.m. At this time. So yeah. All right, let's move on. So what I want to now look at is the behavior of other agents, the behavior of other agents and how they would affect the behavior of your agent, for example. This is basically just game theory. And a simple example that I usually just use here is, actually I just learned this in class a while ago. The what do you call that? The dove hawk game. If you were in a bridge, you're in a bridge and you see an animal on the other side, and that animal is very, very aggressive. It seems aggressive. You both have options to you, right? You have the option to concede and retreat, like you allow the animal to walk through the bridge, or you have the option to try and scare the animal and then threaten the animal and then act tough in front of them and act like a hawk. It's either you act like a hawk and be tough, or you act like a dove and you try and hide away and let the animal pass through. Like the animal only wants to pass through, right? But the animal also has that option to them. The animal could let you pass through, right? Or the animal could act tough and then could act like a hawk and then try and scare you away or something like that, right? Obviously here, so the payoff is formulated as such. If you both of you were to participate in this acting tough option, like you both act tough and try and threaten each other at the same time, you actually might end up in a fight with the animal, and that's definitely bad for both of you. You're both gonna be injured, you're both gonna be very worse off, and you have significantly bad penalties in doing that. If you both concede, and then you don't pass through the bridge, then you just get net zero, right? Like you have zero, you get nothing from it. You conceded, the other person conceded, you're not gonna move anywhere, and that's it. But if you conceded and the animal acted tough and then they walk through, then the animal gets all the benefit. They have the best time of their lives. They walk through and they're leisuring through, and you actually lose nothing because you were able to concede. You bowed down to the animal. You let them pass through. Same as vice versa, which is why in economic jargon this would be seen as a Nash equilibrium. It's a Nash equilibrium because if you were in the strategy wherein one would concede and the other would be aggressing, there is no incentive for you to give up your position or to change position anymore, because if someone was definitely aggressing and you were already conceding, there is no reason for you to aggress because aggressing would be worse off for you. Whereas obviously for the animal, that same thing is also true, which is why there are two Nash equilibria here. In other words, agents make decisions based on the decisions of other agents, even in non-zero sum games. So let me give you an example of a non-zero sum games, even where there is no direct trade-off. So I think this might be fair. Like this isn't. Let me just be clear. In an academic setting, this is not formally a zero-sum game, but where there's a trade-off, this is a good example. If you were in a duopoly and you're cooperating and you're either competing against the company that you're with, and if you pull out of a pull out and drop out of the company, and both of you are losing money over and over again. If you pull out very, very early, you might allow the other company to benefit for a very, very long time, and they might earn a lot of money in this process. And then the trade-off is that you're not capable of earning that money anymore, because you could have otherwise earned the monopolistic profits that you otherwise would have. But if you stayed alongside and you didn't drop out and the other company did not drop out, then you would both lose a lot of money together because you're both losing money already. So you can only earn the profits if one person drops out and the other person stays for a very long time. It's kind of like the Dove Hawk game that I just mentioned to you already. So in that sense, there's a very clear direct trade-off that one person is losing out and the other person is benefiting in this process. But you can also make decisions even if there is not a direct trade-off. So for example, if you knew that more and more people were opting into a certain financial investment program, let's say it is, I don't know, an NFT, for example, and people are playing Axie Infinity, blah, blah, blah. And you believe that you participating in this game is going to be easier to do because a lot of your friends are also doing it as well. And your belief is that, oh, if I join in Axie Infinity, then and more people are already doing it, surely it's going to be safer to play Axie Infinity now because more and more people are investing their money in Axie Infinity. That belief obviously is not zero sum, right? It's not zero sum because you losing money does not mean everyone else automatically loses money as well. So it's not zero sum. But what we are saying here is that you may still make your decision based on how other people behave. If more and more people opt into Axie Infinity, it might be more likely you might also opt in as well. Because again, social conditioning and also the environment that you are also in, also the endorsement of other individuals, or also the belief that it becomes more stable, as I mentioned. And what is important to point out here is that alone can be very, very risky. It's evaluated in the second bullet point that I just mentioned now. It is possible to reach a stable equilibrium point that is not Pareto optimal, which is not the best outcome for everyone, because of how the mutual incentives may align. Again, the example I just gave you. If everyone were already in Axie Infinity and everyone's investing already together and they're playing the game already, it may be a stable equilibrium point because, Axie benefits, they get a lot of investors, they get a lot of people paying money, and some people might earn money in this process and some people might not earn money in this process, etc., etc. But otherwise, it's going to be stable. But that might not be Pareto optimal. Maybe the entire industry is going to be losing money over a long period of time. Maybe the entire industry might collapse at a certain point in time. And but no one is able to see that because no one is able to deviate from their current strategy because their mutual incentives currently align in currently investing in this venture. And that might be in their best interest. Again, in their best conception of what their self-interest is, which is to continuously invest and to be in a place wherein more people are also investing in a stable income source right now. Which is why, it is possible for you to argue that the way people have formulated their mutual incentives may lead to a tragedy of the commons. It may lead to a situation that is bad for everyone. I mean, like, it's the same situation. Like, if many developed countries were all polluting and they don't feel the effects of climate change, it is within their incentive to keep on polluting because it's very, very cheap. But it might not be best for everyone in the world because the developing world might eventually collapse, and then eventually it also might be bad for everyone else in the developed world as well. But the developed world cannot see that right now. So again, there's a stable equilibrium point right now, but it might not be Pareto optimal. And that's where you might argue that it is necessary to change behavior or have direct interventions that might change how people align their incentives or how people would be punished or rewarded for doing certain things and avoiding certain types of actions, etc., etc. Let me now give one last example here. The last example is this House opposes the Biden administration plan to finance large-scale government projects through multi-trillion-dollar fiscal stimulus. This is a very, very simple example that I think illustrates that if you were to talk about an argument, like a very, very specific argument at opposition, that this plan to finance governmental projects is likely going to revive the developing world economies, that's your argument that you're going to make at opposition. Like, if the Biden administration invests in their domestic industry through this large-scale government project, it is more likely the developing world might also invest as well. You would argue that right now, there are many reasons for the developing world not to invest or to risk affiliating themselves or opening up their market to the rest of the world, right? Right now, it's very, very risky to expose their economies to others because their currency might collapse. Or you might also argue that the Biden administration has been very, very, very hesitant to invest in the developing world, etc., etc., blah, blah, blah. And you might say that this decision is made in comparison to the decisions of other developing countries too. If the ASEAN does not invest, or if what do you call that? The European Union does not invest, or if your neighboring ally or some other superpower does not invest as well, it also makes it harder and harder for you to also opt in to this investment plan. So you would argue the only mechanism that you have left to argue the likelihood of success of this is to demonstrate that other institutions are likely to invest at the point in which this large-scale government project makes it more likely that one person or one company creates an incentive for multiple companies from other places to also mutually invest into the US economy, and thereby also expanded investment into the developing world as well, thereby reviving international trade and international relations in a way that would have otherwise not been possible in the post-COVID world. Again, this motion was made in that context, right? Because the government project was made with the specific intention of reviving the manufacturing industry in the U.S. economy, so that they could revive international and foreign investment, and also eventually increase their operations in making other economies also invest in the manufacturing sector, in accepting the goods that would come from the US, etc., etc. So again, that's one way to argue that specific incentive structure and how other agents would also behave in accordance to that. Obviously, you can argue that this other agents would differ because people conflict with one another and there are many divisions in this. Like you could say NATO is very fragmented, and then the reason as to why they would be unsuccessful in intervening in Ukraine, blah, 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 for these reasons would be ABCD, 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 blah, blah, blah. But you can also argue that these incentives might also align if other agents would have made this decision in the past through ABCD, ABCD, ABCD. So all of these things might be possible as well. Okay, I'm going to the last one for this utility function portion on this one. So we are still set on time until the question and answer portion. So time preference. Agents may also tend to discount the future and may value the long term versus the short term differently. Guys, by the way, I'm talking, this is a different concept than what you might be familiar with if you are, if you're an accounting student in university, or if you've had accounting classes in high school before. This is different. This is a different concept than time discounting on the on bonds or on stocks, right? That is done against a specific interest rate that exists in the economy. I am talking about the specific internal discounting rate that you experience as a person. Like, for example, if you were a middle-aged parent and you have a child, you might not discount the future as much because you care a lot about the education of your child, which is why you might invest in a trust fund, for example, or you might invest in paying for all of their college costs upfront agad, as soon as possible, so that they would not have to bear these costs in the long term. So in that sense, you value the future very, 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 very highly, and that is why you're investing in the future very, 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 very highly right now. But you may also discount the future as well. You may think that the future may be unimportant in other aspects, and thereby you might also value the events that may possibly accrue according to this also not as much. For example, the example I gave a while ago, you might think that the actual cost of climate change happening is very, 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 very low. Or it's also very, 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 very unlikely because it's happening so far into the future. So you're discounting this, the value of $1 million of damage of climate change to your economy. You're discounting that a whole lot. And the higher your discounting rate is, the less you are prioritizing this in your initiatives or in your courses of action today. So you would say that, oh, because climate change is so far off and I don't value the future as much, I would probably value instant gratification more, and I value short-term benefits more for various reasons, etc., etc. This can also happen at an individual level, as I mentioned a while ago. It can happen when you take a loan. It can happen when you pursue a certain course of action. Like, for example, when you, what's a good example for this? When you start your own startup, for example, like you don't believe that automation might be as powerful in the future, or something like that. And you would discount the future on that basis as well. So one thing that I want to mention here on an insight level is that this is not necessarily a bad thing, right? This is not necessarily a bad thing. Obviously, none of these are inherently bad things. Like, there's nothing wrong with not prioritizing the future as much, because obviously the counterfactual of that is that the more you value the future, the less you're valuing the present. Well, obviously there are many reasons to value the present and the value of current happiness you would experience. What I'm emphasizing here is that future happiness is part of current happiness. This is super important. because it is still the same utility function. It's still the same you, and it is still the same costs you are paying for. Because every money you spend on paying for the education of your child is money that you are shouldering in the present that you could have otherwise spent on playing video games, buying Lego Star Wars, or whatever, right? You could have done all of these things that would make you happy right now that you are foregoing in favor of a future benefit. Again, what you are arguing is that you are happy, you are attaining happiness in the process of investing in the long run. And that is the utility you are experiencing. Right? The rate of discounting then may differ depending on the risk profile of the agent and on their economic circumstances, whether they're poor or rich, what economic situation they are currently in, and also the risk profile of the agent, which is also determined by a multitude of factors, which obviously I can't cover in this lecture, but I've already mentioned a lot of them right now. Like your risk profile can be determined by your environment, by your context, can also be determined by your previous behavior, by how certain things have affected you. And it's also affected itself by time preference as well. Like it's also self-reinforcing that the more and more you might have a behavior of habitually investing into the future, like you're being nudged to pay for insurance, makes it also more and more likely you might also invest in other insurance ventures that are also very safe for you as well. All right. Again, this is on time preference and on discounting, like valuing the long-term and short-term differently, holding scale and all else equal. I just want to mention that again, it all just depends on scale, right? Like if you have a prospective high amount of profits into the future for doing a certain investment, but you do not value the future as much, then again, that high investment is discounted significantly. And thus, you might compare that against any other investment you might currently have. Again, in a debate setting, that can be compared against any other thing, right? Any other future prospective benefit you might get, like migrating to another country, or for example, what's the example we were giving earlier, like going to a casino versus investing on education or something like that. All right. Example, this is the World Semis. This house believes that, is it quarters or semis? Quarters. Yeah, this house believes that developing countries should acquire on the open market large stakes in major publicly traded global corporations, Google, JP Morgan, Shell, and Pfizer. I think it's important to mention here in this example that people would argue that, it might be good to get money from a large global corporation. You can get a lot of dividends. You can get a lot of control over these companies, and you can also get a lot of leverage in the way in which they structure these companies, etc., etc. But again, what's important to argue is how likely are you going to get these substantial changes? How long will it take? And how can you compare the cost of buying these shares? Again, the cost of buying these shares is shouldered as an economic cost that exists in the now versus the discounted benefit of getting these potential reforms and changes, which in and of itself are very, very hard to achieve, right? When we make it more complicated, we are combining probability, expected utility, and time preference at the same time. There's an entire academic literature on this, but in debate setting again, we are saying that a very low likelihood benefit that is super, super high, that is discounted even more into the future, is even more unlikely to be super happiness giving to an agent that is participating in a certain investment, such as acquiring large stakes in major publicly traded global corporations. Obviously, you can argue the counterfactual that this benefit in the long run is substantially high, and that there are many reasons that the developing world would not discount this type of benefit because they feel They feel that the future is more important for a variety of reasons, and they're more acknowledging of this for a variety of reasons, etc., etc. But you can also argue many other things, such as that the prospect of failing for this company is also not something that is highly valued as well for many reasons, and thus does not significantly affect the decision-making process of many institutions and other corporations that are investing right now. So for example, if in 50 years from now, if JP Morgan is going to be broken up, that doesn't affect the fact that other banking institutions are already very invested in JP Morgan, and that JP Morgan will be very, very profitable in the next 20 to 30 years. Which means that it is still definitely valid to argue that many of these short-term benefits are definitely very, very important relative to the long-term risks of investing in global corporations. Again, these are all bouncing balls that you can play around with. And that is part of debate. That is part of what we are exercising. All right. I'm moving on to the last slide of this presentation and lecture, and then I will move on to open it for comments and then feedback or any questions, etc. But allow me first to just drink some water. All right, so we're on the last portion now, the last slide. There are some final notes that I want to just talk about on stability and uncertainty. Guys, there are a lot of moving parts in debates, and there are many things in debate that are very, very uncertain. That is obviously why I've emphasized time and time again in all of my lectures and in this particular lecture that it is very, very important never to argue in absolutes. Never argue just in absolutes. That is just so weird, and that is unfortunate. What I would recommend instead is to embrace uncertainty, and how people make decisions in conditions of uncertainty. That's very, very important, especially in analyzing agent behavior, because isn't that so realistic? Isn't it just realistic that people make decisions given incomplete circumstances all of the time? And thus, that is a better way for you to understand human behavior. In debates, the condition of uncertainty on the future, or even sometimes in the present. But I think I just wanted to emphasize on the future because, like, there are many things that are more uncertain because we just do not know what will happen in the future. It's important to analyze this and its effect on the decision-making of agents. It's very, very important to consider these aspects because in a condition of uncertainty, or otherwise known as a situation where you have unavailable information makes it difficult for you to make certain valuations on probability, and also makes it harder for you to make evaluations on certain types of things like how much you should discount it or how much you should wait for it versus other things. It is important to always ask, how does this uncertainty come about? What are the sources of stability and of uncertainty? How do crises come about? How does conflict happen? And how does this stable state of affairs get disrupted? How does that then change agent behavior? Again, let me give one example. Remember the nuclear development program that I mentioned a while ago? If everyone were developing that mutual program and mutually assured destruction happens, how does a crisis in this situation come about? How does conflict happen? What disrupts this mutual incentive process? What makes it harder for individuals to opt in or comply with certain economic sanctions? What also makes it difficult for certain types of states or banking institutions to buy into the deregulation of the financial sector? What makes it more and more likely for us to invest in, I don't know, climate change or in green technology, for example? All of these things are sources of uncertainty, or automation or AI or whatever, right? These are sources of uncertainty on what will happen in the future. You can also be uncertain about government. You can also find stability in government. And as I also mentioned, you can also find stability in situations that are not Pareto optimal, which are also situations you might also argue that are uncertain too. Like you can also find situations wherein people agree on a stable equilibrium point, wherein they agree to mutually disarm their and de-escalate conflict, knowing that the other partner might not behave in a particular way, etc., etc. One example I just want to demonstrate to this point is this House believes ASEAN should aggressively pursue economic integration, even at the expense of other trading arrangements with non-ASEAN members. So again, there's a lot of uncertainty as to whether or not ASEAN will be successful in pursuing economic integration, right? Like, will it have its own economic currency? Will it be able to have the free movement of labor like the European Union does? Will it be able to reduce its dependence on other strong economies around the world, like the US or China, for example, or Russia? And is the cost that you will have and shoulder on other trading arrangements, is it as substantial as other things? So when you are debating, do not just say that the cost will be high. You have to argue how can you unpack this uncertainty on what will be the tipping point on when these costs are higher or when these costs are lower? Or what is the tipping point between when economic integration becomes more successful or less successful? These are all issues and sub-issues that coexist in the debate and thus should not be assumed to be given in a debate when you are arguing certain courses of action. And I think this is very, very important whenever we're considering these types of debates. All right. I think that should be fine. So uncertainty is fine. You embrace uncertainty. We make decisions on uncertainty, and you have fun in uncertainty. There's a quote that from The Big Short that I would quote here is that the Michael Burry was being pressured by the investors to give up the shorts that he had on the housing market because they were crashing and the money was going away. And he was saying that there's definitely a bubble in this market. And then the investor replies to him that no one can see a bubble. That's why it's a bubble. And I think that captures a lot of what goes on in debates on economics when no one knows what they're doing or talking about, and no one knows what is actually going to happen in the real world. So in debates, when you are made to deal with uncertainty, it is important to be very, very, very nuanced under the specific circumstances in which specific decisions will be made under specific sets of utility functions and in how those values interact with one another in a market, in an economy, or as I mentioned in the very, very beginning of this lecture, in an understanding of how this influences their decisions as individual entities. All right, that's pretty much it. I'm done with this lecture. Are there any questions? You can ask them now. You can now open the Slido and then we can.
Thank you, Luigi. I'll be sharing my screen for the Slido. Please give me a moment.
Sure.
My screen can be seen.
Yeah, I can see it. I can see it.
All right. So this is the first question that you received.
Well, very little. My answer to that. So the question is, what do you suggest is the level of influence of a poor person getting a loan from a bank in the economy they're in? Very little. Mostly because if a bank was accepting loans from poor individuals, it's most likely that they have a lot of other loans from more or from other individuals that are less risky than them. So obviously, if we're talking about an individual entity, they have very significant low leverage on the bank because likely enough, they don't have enough money to influence the entire stocks and the entire shares and not the shares, the holdings of that bank. And thus it is very, very difficult for them to make significant change in that. So what's a better way to argue this type of argument? It's better to argue it in terms of many poor people doing it collectively and thus making it a significant risk to the company, but also other banking institutions knowing that other banking institutions are also doing the same thing and conducting predatory lending to other poor individuals as well. Given this, you can argue that as a lot of individual entities that have leverage on multiple banking institutions across the entire financial sector, they do have some significant influence, right? I don't know what level you're talking about, like level A, B, C, D. I might say it's a C tier. I don't know if it's a B tier though. So yeah, next. Yeah, so the next question was on the stock picks. So my answer to that is I don't have any. Game. Next. In the motion about big casinos, you mentioned as well the incentive of the casinos there. How do you prove the incentive of big casinos is relevant? Well, this is very intuitive. I think you answered your own question. The incentive of big casinos is that they want to enter into an economically disadvantaged area and compete against other big casinos. That is relevant precisely because the big casino is what would function in order to improve the economy of the economically disadvantaged area. Yeah, that's a good answer. All right. Next, in THBT debates, I assume this means this house believes that people tend to accuse other teams as irrelevant when they try to bring up incentives of certain actors. How do you prove an actor is relevant? How do you prove that an actor is relevant? How do you prove an actor is relevant? You prove an actor is relevant in many ways. One of the ways I would explain is through framing. So how can you frame an actor to be important? You can frame it to be important as in the sense of, do they have significant leverage or influence? What is the context in which this actor behaves against relative to other actors in the debate? Like, what are the relationships they have with other actors in a particular context? Like, is it employer to employee relationship? Is it like a state institution to a citizen relationship or something like that? You may also argue that their influence on affecting other groups of people is also very, very strong. Like, again, remember that example I gave early on in the lecture, like those rural Rust Belt conservative working class individuals is faced by globalization. You can improve that their incentives are very, very important because they compose a significant proportion of the population that might affect elections into the future, or they might be able to influence the poor communities that reject globalization in these areas, and thus makes it harder for foreign investment to come in into the future. And thus you're making the impact of this incentive of certain actor very, very important in a debate. Next. What does embracing uncertainty mean, especially since debate is a battle of likelihoods? Well, that is exactly what I mean. Because debate is a battle of likelihoods, we embrace uncertainty because you're arguing along the lines of uncertainty instead of along the lines of absolutes. That's literally just what I mean. I don't mean to go into the terminology of what a battle of the bands looks like, or what a battle of the likelihoods look like, and what embracing or rejecting looks like. I just mean you argue along the terms of uncertainty is endemic in all debates, and thus you argue in terms of how people deal with uncertainty and how people make decisions in uncertainty, and how that might affect their decision-making process, and whether that it's good or a bad thing. That is what you argue later on. How do you suggest debaters compare short-term benefits to long-term benefits? Very simple. You just argue it in terms of probability. You argue it in terms of scale. You also argue it in terms of severity. And you also argue it in terms of like how approximate it is, right? That might be one way to think about it. Yeah. Next. You mentioned we should be careful about specific nuances, but debaters can easily dismiss us as too context dependent. How do we combat this? That is not your problem. That is their problem. I think being context dependent is everything in debate. All debates are context dependent. If you think about it, there's no argument that is context independent. Is there any argument that is context independent? No. There's no context that is context independent because all arguments are situated in a certain context. And thus, nuances help the argument. They do not detract from the argument. Obviously, if your argument is irrelevant because you're operating in like the 0.01% of cases, then that's how you combat it. Like you say that it's irrelevant because it's not a real thing. It doesn't happen. That only happens in an infinitesimally small number of cases. Again, debates are won in the vast majority of cases, not on like the marginal, super unlikely, unimportant cases. Game. Good day po. Good day. How do you also use this lecture in a non-economics motion? Can you use the PIDC motion about not outsourcing domestic work as an example? What is the PIDC motion on not outsourcing domestic work? Anyways, how do you use this lecture in a non-economics motion? I'll just answer that na lang. Again, what I mentioned in the first part of this lecture, very simple. You can just like the argument I said a while ago was on voter apathy. Why is it likely that individuals might engage in voter apathy against each other or against state institutions, even if they have a significant likelihood of chance wherein it might be a very close election? Like let's say there were like 51 conservatives and there were 49 liberals in the same election. And you know, the wasted vote paradox would essentially say that because among the conservatives, since it is better for them in their self-interest to stay at home because they're guaranteed to win if they believe that everyone else is going to vote anyways, then they would stay at home and one person would deviate from the norm of voting in the election. And thus, you would argue that because lots of other individuals also believe that this is also likely to happen for everyone else, then more and more people would not participate in the election at all. And thus, you would erode the trust of democratic institutions. You'd also make it unlikely for other people to participate in the election. And thus, it becomes harder and harder for people to cooperate with the state institution in the future as well. All right. So in general, I think that you answer this by all non-economics motions have some agents, right? Like any motion on, what is that? What is a non-economics motion? Gender, social movement, protest, have likelihood of successes. They have a short-term, long-term benefits. They have social movements and different groups of individuals that are also competing interests and incentive structures within it. All of these things are incentive structures. So there are also ways in which you formulate how people behave and how people formulate their own utility functions within their respective themes. All right, next. Out of all the factors that may affect one's utility function, which do you think? Hala, nawala na tuloy ang ating kaibigan. Anyways, the last question was just about what do you call that? Which is the most important? Honestly, I don't know. That is not for me to decide. That's for you to argue and debate about. Obviously, there are many ways that you can explain it, and that's fine. Yeah. So it's dependent. Sir, what resources do you suggest for us to further understand your lecture better? I do have some resources that I have actually. Let me take a moment to bring out my document where I keep most of my resources. There is a very specific one that I like. Actually, let me just say it. You can watch the movie. What do you call that? What movie is that? I Like the Big Short. Watch the documentary. What's the documentary? Commanding Heights documentary for international trade. The Big Short, if you want to learn more about the financial crisis. If you want to read on books and stuff like that, Why Nations Fail is also a good starter. And I think that's really good one to start with. All right. Any other questions? Oh, okay. Thank you, Sir Luigi. All right. No worries. Anyways, I'll start with my inspirational message at the end of this lecture. If no one else is going to be asking questions. So I believe that NDC, national tournaments, Philippine debating has a lot of potential. But it's only built on people that care about the community and develop humility, develop a sense of community that makes it easier for people to feel included in this sport. There are many ways in which debate can become toxic and exclusive to other people and make people feel unwelcome. And obviously, there are many ways in which people can feel that they don't understand anything in the community anymore because we become so detached. I believe that it is important that all of us work deliberately to understand each other's arguments and to try and not just break each other apart and accuse each other of so many random things that are unimportant in debates, but try and actually work with the debate you are in. And thus, I think that will make for better debates, better learning, and better debating cultures that I think would be better for everyone in this sport. We have a great community. We have a great potential community. A lot of things you can learn, a lot of topics you can learn from, a lot of good people that are in this community, a lot of potential. And I think this all starts from developing heart, developing humility, and developing good spirits. All right. I think there's nothing else to be said anymore here. So I wish everyone good luck and stay safe and take care of yourselves and do everything well. Otherwise, if there anything else you guys want to talk about, then just GG's. Then just you can just message anytime. All right, thank you everyone and goodbye.